Okay, let's unpack this. We are diving deep into, well, car insurance. That one thing pretty much every driver needs, but honestly, it's wrapped up in so much confusing jargon. It's a total necessity, right? But figuring it out shouldn't feel like you need a law degree.
It really shouldn't. And that's kind of our mission today. We want to cut through all that complexity, give you, the listener, a real shortcut to understanding it better, maybe feeling more secure. By the end of this, you should really get the key things that drive your price. And crucially, know what all those coverage types actually mean for your wallet.
Exactly. And the main idea, I think, is that car insurance is totally personal. It's like a fingerprint, you could say. Insurers look at, what, almost a dozen different things?
At least.
Right, to figure out your premium. So the best quote for you won't be the same as for your neighbor or your friend. You can't just copy theirs. Okay, so if it's that personal, what info do people actually need to pull together to, shop around and get a solid quote? I know those quick anonymous quotes you see online, they're often not very accurate. So what makes a quote reliable?
Yeah, to get a number you can actually trust, you need to be ready with some details. Start with the basics. Driver info, names and birthdays for everyone licensed in your house. You can usually get a quote without the license numbers at first, but you'll definitely need them handy when you go to buy the policy. It's good to just get them early.
Right, and then there's the one that catches people off guard sometimes, right? The credit check.
Yes, that's a big one. In states where it's allowed, and that's most states, the insurer will likely run what's called a credit-based insurance score. It's not exactly your FICO score, but it's related. And yeah, it's a pretty major rating factor.
Wait, hang on. So my credit history, which feels like it has nothing to do with how I drive, can actually affect my insurance premium. How much does that really matter compared to, say, my actual driving record?
Oh, it can matter quite a bit. Insurers see it as a predictor, rightly or wrongly, of financial responsibility and how likely you might be to file a claim. But you mentioned the driving record, and that's where things can get really tricky when you're shopping.
Ah, yes. The critical detail that can totally change your quote right at the end. Why is being upfront about tickets and accidents so important?
This is probably the #1 reason a quote you get online suddenly jumps up when you go to buy. You absolutely have to disclose every accident, every ticket, any license suspensions for all drivers on the policy. And they often look back like 3, 5, sometimes even 10 years, depending on the company and the state. The thing is, most insurers don't run the official driving record from the state until that final moment, right when you click purchase. So if you maybe forgot about a speeding ticket or didn't mention a small fender bender, that great quote you thought you locked in can suddenly shoot up by hundreds of dollars.
Wow. So it's really this mix of things. Your age, where you live, the car itself need the VIN for that, right?
Yep, the vehicle identification number helps them understand the car's risks, repair costs, safety discounts, all that.
Okay, so age, location, car type, your driving history, your credit history potentially, and then, of course, how much coverage you actually pick. It really is like a dozen data points building that final price tag. It's complex. Okay, let's switch gears a bit. We've talked about getting the quote. Now let's build the actual policy, your financial shield, let's call it. We have to start with the absolute baseline, the part that's legally required almost everywhere, liability coverage.
Liability is definitely the foundation. You can think of it as transferring your financial risk to the insurance company if you cause an accident. Super important. This coverage doesn't have a deductible, and it helps cover lawsuit costs and legal defense if someone sues you, but only up to the policy limits you choose.
And liability usually comes in two main parts. First up is bodily injury, BI.
Right. BI is for the other person's injuries if you're at fault. It pays their medical bills, maybe lost wages. You'll typically see this written with split limits, like maybe $50,000, $100,000.
Okay, what do those two numbers mean?
Good question. The first number, the $50,000 in this example, is the max the policy will pay for one single person's injuries in an accident you cause. The second number, the $100,000, is the absolute total the policy will pay for all injuries combined in that one accident, no matter how many people were hurt.
Got it. And the second piece of liability is property damage, PD.
Exactly. PD pays to repair or replace other people's property that you damage. And property here is key. It's obviously the other car involved, but it could also be, a guardrail you hit, a mailbox, someone's fence, even the side of a building.
Okay, now this brings us to what you call the state minimum trap. You see those limits advertised sometimes, maybe 2,550 or 10. That last number, $10,000 for property damage. I mean, with car prices today and repair costs, That sounds terrifyingly low. What's the real danger there?
The risk is, well, it's profound. That 255010 means your insurance will only pay up to $10,000 total to fix or replace the other person's car or any other property you damage. Just think about it. Fixing just the complex headlight on a newer SUV can cost thousands, sometimes over $5,000 easily.
Right.
If you hit a brand new truck and total it, that $10,000 is gone in an instant. If the total bill for their vehicle comes to, say, $50,000, and you only have $10,000 in PD coverage.
You're paying the other $40,000 yourself.
Exactly, out of your own pocket. Savings, wages, garnish, whatever it takes. That kind of financial hit can ruin people. And that's why basically every insurance professional strongly advises getting much, much higher limits than the state minimum.
Okay, so that's covering damage you do to others. But what about protecting yourself? Turning that shield inward, so to speak. Let's talk about filling the gaps, especially dealing with drivers who might not have insurance or not enough. Uninsured and underinsured motorist coverage, and UIM.
Yes, and UIM. Honestly, this is protection you really don't want to skip, given how many people unfortunately drive without insurance or just the bare minimum. Uninsured motorists, the UM part, pays for your medical bills if the driver who hits you and is at fault has zero insurance. It also often applies in hit-and-run situations where the driver isn't found. Then there's underinsured motorist, UIM. That kicks in if the at-fault driver has insurance, but their bodily injury limits aren't high enough to cover all of your medical expenses. UIM helps cover the difference, up to your own UIM limit.
And there's a property damage side to this, too, sometimes.
There can be, yes. It's called uninsured motorist property damage, or UMPD. Remember, your regular property damage liability, PD, pays for their car when you're at fault. UMTD helps pay to fix your car when they're at fault and uninsured, but there's a catch. Often, for UMPD to apply, the uninsured driver has to be identified.
Yeah.
Doesn't usually cover hit and runs to your vehicle.
Okay. Next up, things that sound similar but are different, personal injury protection, or PIP, versus medical payments or MedPay. How do we sort these out?
Okay, yeah, they both cover medical bills for you and your passengers no matter who caused the accident. That's the key similarity. But here's the easy way to think about it. If you live in a no-fault insurance state, you'll primarily deal with PIP. PIP is usually mandatory in those states, and it's broader. It covers medical bills, yes, but also typically covers lost wages if you can't work, and maybe even essential services you now have to pay for, like childcare.
And if you're not in a no-fault state,
Then you're looking at MedPay. MedPay is generally optional, though I think Maine and New Hampshire might require it. It just covers medical expenses, typically up to a lower limit, say $5,000 or $10,000. It does not usually cover lost wages or those extra services like PIP does. Here's a slightly surprising detail about MedPay, though.
Ooh.
It might even cover you if you're hit by a car while you're walking as a pedestrian, so it can offer this little extra layer of protection many people don't realize they have.
All right, let's talk about the part people often mean when they say full coverage. That's not really an official insurance term. But generally, it means adding two important coverages, collision and comprehensive. These are usually optional. Unless you have a car loan or lease, then the lender makes you get them right. This is about protecting the car itself, the actual asset.
That's exactly right. Collision coverage, often just called QOLL, pays to repair your vehicle after an accident regardless of who is at fault. So if you hit another car, or if you back into a pole, or even if you hit a massive pothole that damages your suspension, or heaven forbid, you're in a rollover accident, collision is what covers your car's repairs.
Okay, and unlike liability with its dollar limits like $5,100, collision works differently. It pays up to the car's, actual cash value, ACV.
Correct. Actual cash value, ACV. And this is a really important concept. ACV isn't what you paid for the car. It's what your specific car, with its age, mileage, condition, and depreciation, was worth in the market right before the accident happened. So if you bought a car for $40,000 a year ago and it gets totaled today, you're likely not getting $40,000 back. You're getting its current depreciated value.
Ouch. So basically, you need to think about coverage based on what the car's worth today, not what you paid or what you might still owe on it. That difference, the depreciation, comes out of your pocket unless you have something like gap insurance, which we'll get to.
Precisely. And the other half of this full coverage equation is comprehensive, sometimes called COMP or OTC, which stands for other than collision. Comprehensive covers damage to your car from almost everything except a collision or rollover. Think theft, vandalism, fire, storm damage like hail or flooding, maybe a tree branch falling on it or hitting an animal like a deer.
And the handy one, comprehensive usually covers cracked windshields too.
It does. That's a frequent claim. And often under comprehensive, there's a separate lower deductible specifically for glass damage. Sometimes it's even a $0 deductible, which makes getting that chip fixed pretty easy.
Okay, that word deductible brings us right to it. Since collision and comprehensive do have deductibles, unlike liability, how should you think about choosing that amount? Say between $250, $500, or $1,000.
Yeah, the deductible is basically your share of the repair cost. You pay that amount first, then the insurance pays the rest, up to the ACV limit. It's a trade-off. If you choose a low deductible, like $250, it's easier to afford if you have a claim, but your regular insurance premium will be higher. If you choose a high deductible, like $1,000, your premium will be lower, saving you money month to month. But you have to be sure you can actually come up with that $1,000 if you need repairs.
So it comes down to your budget and risk tolerance.
Exactly. Set it based on what you could comfortably pay out of pocket tomorrow without causing a financial crisis.
And I've heard some companies offer ways to lower that deductible over time.
That's right. Some insurers have diminishing or vanishing deductible programs. Basically, for every year you drive without an accident or claim, they might reduce your collision deductible, sometimes all the way down to zero. It's a nice perk if you can get it.
Okay, almost there. Let's quickly cover some common and often really useful optional add-ons that can sort of seal the deal on feeling fully protected. Gap insurance seems critical, especially for newer cars.
Oh, gap insurance can be a real lifesaver, especially if you buy a new car that depreciates quickly. Like we said, collision pays the ACV. But if you owe more on your loan or lease than the car's ACV when it's totaled or stolen, that difference is the gap. If you owe $30,000 but the ACV is only $25,000, gap insurance covers that $5,000 difference, so you're not stuck paying for a car you don't have anymore. Usually makes sense for cars less than, say, 3 years old.
Makes sense. And if you only have one car in the household, rental car reimbursement sounds pretty essential too.
Definitely. If your car is in the shop for repairs after a covered accident, this pays for a rental car, usually up to a certain amount per day, like $30 or $50 for a set number of days. Keeps you mobile. Then there's roadside assistance, covers things like towing if you break down, flat tires, jump starts, maybe locking your keys in the car. It's often cheaper to add this to your auto policy than buying a separate AAA-type membership.
Right. We also hear about accident forgiveness. What's the deal there?
That's a feature some companies offer, sometimes for an extra cost or as a loyalty reward. It basically means they won't raise your rates after your first at-fault accident. Since surcharges after an accident can last for 3 to 5 years, forgiveness can save you quite a bit in the long run. And one more for new car owners: new car replacement.
How's that different from Gap?
Good question. If your very new car, usually defined as like one model year old or newer, under a certain mileage gets totaled, this coverage pays to replace it with a brand new car of the same make and model, ignoring depreciation completely. It's more comprehensive than Gap, but usually only available for truly new vehicles.
Okay, so we've covered a lot of ground. Bringing it all together, what does this really mean for you, the listener, trying to balance your budget with, actually being protected?
I think the crucial takeaway is understanding that balance. Affordability today versus potential financial disaster tomorrow. State minimum coverage, yes, it's the cheapest way to be legal, but leaves you incredibly vulnerable financially. With medical costs and car repair costs being what they are today, just soaring, insurance pros almost universally recommend boosting those liability limits way beyond the minimums. Maybe something like $100, $300, and $100. That's $100 case per person BI, $300 K per accident BI, $100 KPD. And definitely adding comprehensive and collision unless your car is, really old and not worth much.
Right. You really want to avoid being the person who causes a bad accident and then spends the next 10, 20 years having their wages garnished because their insurance only covered the first $50,000 of a $200,000 judgment.
Exactly. And that really leads to the final thought, a question for you to consider. Driving without any insurance or even just being severely underinsured isn't just about risking a ticket. The consequences can be devastating. Huge fines, losing your license, having your assets seized if you're sued, wages garnished, like you said. You might even end up needing an SR-22 or FR-44 filing, which is basically the state forcing you to prove you have high-risk insurance, and it's expensive. So the question is, how much more is paying for a truly robust, protective policy today worth to you compared to the massive risk of potentially having to pay for all the damages, medical bills, and legal costs entirely out of your own pocket tomorrow? Maybe take a look at your own policy's limits after this. Really think about them in light of today's costs. It's worth the time.